onto YouTube probably because I can't get it to go on Canvas. Okay, so let me share my screen. Um, and I'm gonna hide these. Okay, let me close all of this. Okay, so we're gonna start with these kind of conceptual questions. Which one of the following will best reduce the risk of a project by lowering the operating leverage? So let's look at that. Hiring additional employees rather than using temporary outside contractors, buying equipment rather than leasing it short term. No, lowering the project selling price per unit. No, that's not right. And subcontracting portions of the project rather than purchasing new equipment to do all the work in-house. Okay, that sounds good to me. Changing the proposed labor-intensive production method to capital-intensive. No, that's not right. Okay, so it's going to be subcontracting portions of the project rather than purchasing new equipment to do all the work in-house. Okay. Jenners is a multi-vision division firm. Okay, sorry, I gotta make this smaller. Jenners is a multi-division firm that uses its overall WAC as a discount rate for the proposed projects. Each division is a separate line of business, and each presents risk unique to those lines. Given this, a division within the firm will tend to, okay, prefer high-risk projects over low-risk projects. Okay, that's probably true, given that they use their overall WAC for everything. Become less risky over time based on the projects that are accepted. No, that's not true. Have an equal probability with all other divisions of receiving funding. That's not true. Receive less project funding if its line of business is riskier than other divisions. No, that would be true if it was uh, more riskier. They'll receive more funding if it's riskier. And avoid risky projects so it can receive more project funding. That's not true. They're using the overall WAC as a discount rate for everything. So they're going to want to do riskier projects instead of low risk projects. So A is the answer there. Number three, we've got which one of the following provides the greatest tendency to increase the percentage of debt included in a company's capital structure? Okay, we have a low probability of financial distress. That looks good actually. So their greatest tendency to increase the percentage of debt. If they have a low probability of financial distress, they're gonna want to use debt. So that looks good to me. High insider ownership, have very that doesn't have very much of a say. Significant expected bankruptcy costs. If you think they're gonna go bankrupt, they're not gonna use debt, right? Um, Minimal taxable income, no. Very low marginal tax rate. I mean, that's a plus because it makes our cost of debt lower if you have a low tax rate. But this is probably the greatest tendency to increase the percentage of debt. Okay. Under the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005, how long after a company firm files for bankruptcy protection do creditors have to wait before submitting their own reorganization plan to the court? That's going to be, let's see, 60 days, no. 45 days, no. Those are both way too short. 12 months is close. 180 days also too short. 18 months is going to be the right answer. That one you just have to remember. I think there might be, when I took the exam, there's a question about this on the exam, so you might want to remember that, but that's just kind of you got to remember it. It's 18 months. In general, the capital structures of U.S. firms, uh, generally result in debt to equity ratios between 0.45 and 0.55. No. Rely more heavily on debt than equity. That's probably That's probably true, but we're not sure. It's capital structures of in the whole US. There's definitely going to be some people that rely more on equity than debt. So, very significantly across industries, that's probably the right answer right there. Um, Capital structures of US firms, there's some very creative cap structures in the US. So, I would definitely say very significantly across industries. Tend to exceed a debt to equity ratio of 0.45. That's not true. Tend to overweigh debt in relation to equity. That might be close. It's similar to this one, but I don't know. I would say very significantly because that's the only one you know is true, right? Which one of the following statements is correct? Earnings growth tends to lag dividend growth. That's not true. A reduction that means that dividend growth is higher than earnings growth. And if you're a publicly traded stock, like a publicly traded company, you're not going to announce dividends before earnings, right? Your shareholders are there for earnings and high returns, not just for dividends, right? Reduction in personal tax rates leads to lower dividends. No, that's not true. Reduction in tax rates does not lead to lower dividends. Dividend payments are highly concentrated in a relatively small set of large companies. That's true. Um, let's see, let's go through the rest. Dividends tend to fluctuate significantly from quarter to quarter. That's not true. There's like certain companies that are the dividend companies, quote unquote. They're the ones that pay dividends and they're usually very um consistent because that's they know that that's what their shareholders are there for. Um So I would say this D is not correct. It's looking like C is more correct. Short-term fluctuations in cash flows are the key factor in determining a company's dividend policy. That's not true. Short-term fluctuation in cash flows, if you this is saying like if a company has a short burst of higher cash flows, does that determine their dividend policy? I would say absolutely not. If they have one good year, that does not mean they're just going to pay a dividend because they had a good year. Um, they're probably going to reinvest it into themselves if they're not a typical dividend paying firm. So I would say C. Dividend payments are highly concentrated in a relatively small set of companies. There's a small set of big companies, and they're the ones that pay dividends, and everyone trading knows that those guys are the ones that pay dividends. Um, okay, next one. Oh, I gotta select it. Sorry. Okay, next one. All else held constant. A decrease in blank will increase the cash flow cycle. So if we think about the cash flow cycle, um, let's see, payables, turnover, inventory turnover, operating cycle, and accounts receivable period. This is going to be the inventory turnover rate because that's on the denominator, right? So if the denominator goes down, the cash cycle goes up. So it'll be the inventory turnover rate. Um, okay, now we're gonna look at a cash flow statement here. So below are the most recent balance sheets for Country Kettles Inc. So we've got 23 and 24, how their assets are moving from last year to this year. So let's look, and their liabilities, sorry. So let's look here. Accounts receivable, we're gonna see if it's a source or a use of cash. So they went down. So from 23 to 20, oh, sorry, from 23, I was looking at cash. From 23 to 24, accounts receivable went from 71 to 75 thousand, which means we're going to call that a use of cash because they increased an asset. So let's say use of cash by how much? Okay, I'm gonna have to get my Excel open. Okay. By how much? Let's see. We've got last year and this year. We've got 71,900 and 75,280. And it's an asset, so we're gonna do last year minus this year. So obviously it's a use because it's negative. Um, and then the difference is $3,380. So let's write 3,380. And we don't want to put signs here. You guys know this because you've done the homeworks, but you don't want to put signs here because you're telling her the sign right here, use or source. You're telling her the sign right before. So don't like make this negative, right? Enter all amounts as positive. Okay, next one is inventories. Let's look at this. Inventories also are going up. So that's going to be a use of cash. So from last year to this year, inventories went from 62 to 65. So let's go 62,800 last year and 65,375 this year. And the difference is going to be $2,575. So let's write 2,575. Okay. Property, plant, and equipment. This is the last asset. So let's come over here. PP&E. We have it going from 167 to 179 to 179, 800. Okay. So that's also going to be a use of cash. So the asset is increasing, which means we had to pay money for that asset to increase, if that makes sense. So we had to pay cash, use cash to get our PP&E to increase. So it's a little bit backwards, but if you think of last year minus this year for assets, you're pretty good. So I would just keep that in mind. Asset equals last year minus this year. And then you can, from that, you can find out that liabilities is this year minus last year. Anyways, okay. Property, plant, and equipment. This is a use of cash. By how much? Oh, by how much? Let's see. 12,800. So let's type that in here. 12,800. Sweet. Okay. Accounts payable. So now we're on to the liability side. So I'm going to put a little last year and this year. And I'll call these assets. I'll call these liabilities.
Thank you. Yeah, you're welcome.
Um,
Where are you wanting to go? This library?
Yeah, anywhere with a desktop.
Yeah.
Cool. Library.
okay. Accounts payable, let's look at it. We're in liability, so we're gonna do this year minus last year is the equation. And we're gonna start with accounts payable. So we went up in accounts payable, which means our cash, um, we gained cash, right? Our cash didn't go down because our accounts payable went up. So our cash went up. So that should be a source of cash. I'll write that down here. Source of cash, and then let's type these numbers in. Accounts payable 46, 900 and 49, 190. So now we're going to do this year minus last year, 2290. Okay. Accrued expenses, let's look here. Accrued expenses. Okay. We went from 8,280 to 7,220. So we went down, which means our cash went also went down. So let's do 8,280 and 7,220. So this is going to be a use of cash, and the difference is going to be 1,060. Is this making sense to you guys? I'll take the silence as yes. Okay. Long-term debt. So let's see. Yeah, long-term debt. Let's call it LT debt here.
How long do you
Um,
think this final will take you?
Like until like dinner time, I'm sure.
okay. Long-term debt is 27,600.
Statements,
And then
like studying.
31,000 is what it is this year, which means our debt went up, which also means our cash went up. So we're going to call this a source of cash. The difference this year minus last year, 3,400. So let's sweet. Okay, common stock went up. So let's look here. Common stock increased, so that is going to be a source of cash. Let's type that down here, source. And then let's see by
Really want to go to Montana. I want to feed them.
common stock. So this is going to be 36,000,
Thinking really random bet. I was like,
42,000.
man,
So the difference is going to be this year
accuracy.
minus last year.
And it sounds like
Yeah. What
Okay.
we could do for your proctorio exam, we could leave it early.
Okay.
Do your
Sorry,
left
there's someone with their
and
microphone on. If they would turn it off while I'm
you have a
eating, that
probably a
would be
good
great.
hour and a half to take the bench. And if you need more, obviously we can let you take it.
yeah.
Um, okay, I'll keep going.
What time would you want to be leaving tomorrow?
No. Okay,
Um,
sorry. I'm gonna ask if you'll
I've been
check
normally, but it
your,
dropped you off.
please.
Hey, will you mute your mic?
But
Okay, hold on.
That'll get.
Oh, got it. Okay, sorry. I just muted them myself. I didn't know I could do that. That's nice. Sorry, guys. And to everyone that's gonna watch the recording, I'm also sorry you had to deal with that for a second. That's okay. Okay, retained earnings. So we've got 167, 800 and 170, 835. So obviously our retained earnings went up. So that means that's a source of cash. So let's come down here, write source. And the amount, let's check. This year minus last year, 30,000, sorry, 3,035. Okay, sweet. Okay. Next one is going to be the cash cycle. So this one is kind of a crazy one, so let's talk about it. This one's one of the ones you want the formula, right? You get your Excel in the exam, so I would have this formula written down. But okay, so the operating cycle, let's see. Wait, hold on. Yeah. Okay, so the operating cycle, sorry, I'm gonna write it down for you guys, equals the inventory period plus the receivables period. So, and then each of those obviously need their own um each of those kind of need their own formula. So inventory period is going to be 365 days divided by the inventory turnover. And then inventory turnover is COGS divided by average inventory. Okay, so using this, we need to find average so we're just gonna start first off with the inventory period. Then we'll do the receivables period, which is it's pretty much the same formula. I'll write it down really quick. Receivables period is going to equal 365 days divided by receivable turnover. And then the receivable turnover as you can probably guess, is going to be credit sales over average receivables. Credit sales or revenue, whatever you want to use there. For this question, it's going to be credit sales. You can use actual sales as like sales or revenue as credit sales, if that makes sense. It's the same thing. So credit sales over average receivables. Okay, so let's calculate these here. So we need to find inventory turnover first. So inventory turnover is COGS, which is 75,000 divided by the average inventory. So we're going to do 11,500 plus 12,500 divided by 2, except I'm going to need another set of parentheses in there. Okay. So this part right here, if you guys can see where I'm talking, is going to give us the average inventory. And it's going to be, you can probably do it in your head. It's just going to be 12,000. So if you do it in your head, that's great. But I'm going to type everything out so we don't have anyone slip through the cracks. And then COGS over average inventory gives us inventory turnover, which is 6.25 times. So that means that inventory turns over. So you recoup all your inventory 6.25 times per year. And then the inventory period is going to be 365 divided by 6.25, which is the inventory turnover, which gives us 58.4 days. So every 58.4 days, our inventory turns over, if that makes sense. So I'll call this inventory period. And then we'll do receivables period here and receivables turnover. So receivables turnover, same thing. It's going to equal the 95,000 divided by, and then in parentheses, we've got the average accounts receivable, which is going, excuse me, sorry, which is going to be 6,500 plus 6,800. So I'm right here, accounts receivable. And then I'm going to close that parenthesis, divided by 2, close that parenthesis. Okay, so I've got up here, I've got my sales divided by average accounts receivable gives me 14.2857. So that's 14.287 times. And then receivables period is going to be just 365 divided by that. So these are the ones right here that we add together. Phew, sorry, sneezed. I have the worst allergies right now. Sorry, guys. Okay. So this one and this one are the ones we add together because we want to see the operating cycle or the cash cycle. Which means how often how many days our cash is cycling through. So operating cycle is going to be equal to the inventory period, so 58.4 plus the receivables period, which gives us 83.95 days. So that's our total cash cycle. I'll highlight that so we know it's an answer. Okay, and we'll say 83.95 because it says to round to 2 decimals over here. Okay, sweet. Number 10, Jetblue Software is a steel company with 100 million shares trading at $25 a share and $500 million in debt currently. You have run a regression of the firm's stock returns against the average market index using the last 5 years of data and have estimated a beta of 1.06. Oh, wait, sorry. I just remembered, you guys, I did something wrong up here. The operating cycle is not the same as the cash cycle, and I need to fix it. Sorry. I just remembered that. Okay. So the cash cycle, okay, one sec. Um, sorry, I have the key, and so I'm trying to check with what I've got, but I don't know how she gets the um so the cash cycle you're supposed to subtract off 43.31 days, but I don't know where she got that from. So let's take a pause. I'll come back and answer this one later. Sorry. Let's go back down to this one. We've run a regression. Um, we've run a regression of the firm's stock returns against the market index and using the last 5 years of data, and we've estimated a beta of 1.06. So the average debt to equity ratio for a company that corresponds to the data of a beta of 1.06 is 10%, tax rate is 20%. So estimate the beta under its current financial leverage. So under the current financial leverage, this is where we're gonna do some manipulation. So when the debt to equity is 10%, okay. So when debt to equity, let's see what number is this 10. So debt to equity is 10%. The beta is 1.06. So we're gonna find the unlevered beta. Oh, forgot the A. Unlevered beta, which is equal to the levered beta. I'm gonna write the formulas so you know what I'm doing. Levered beta divided by 1 plus debt over equity times 1 minus tax. Okay. Oh, sorry. And let's get the tax rate up in here. Okay. 20%. Sweet. So, let's see. So we've got, for this question, when we're trying to find the unlevered beta, we've got, um, so the levered beta is 1.06. We're going to divide that by 1 plus 10% because that's a debt to equity ratio, and then multiply by 1 minus 20%. Now it should give us 0.98. Okay, perfect. So that's our unlevered beta. And now we need to figure out our current debt to equity ratio. Does that make sense? So let's look here. So our current debt to equity ratio, our current market value of debt is $500,000. Sorry, $500 million, but I'm just gonna leave it in millions. And the market value of equity, let's call this equity, is $100 million. So we're looking right up here. And then, but then that's 100 million shares times $25 a share gives us $2,500 million of equity. So the current debt to equity ratio is going to be 500. So debt over equity. Oh, look, 20%. That's a good number. Okay. So our current debt to equity ratio is 20%. So then we're gonna find the current financial leverage beta. So that's what this is asking for. So first we have to unleverage the beta and then re-leverage the beta at the current debt to equity ratio. So we're going to do unlevered. So let's call this leveraged or levered beta. And that's going to be equal to unleveraged beta times, and then the same thing we divided by up here. 1 plus debt to equity ratio, debt to equity ratio times 1 minus tax. Okay. Does that make sense? That's the formula we're going to follow. Our unlevered beta is 0.98. So we're just going to come down here. Our unlevered beta is 0.98. Then we're going to multiply that by 1 plus this 20%, which is our current debt to equity ratio, times 1 minus the tax rate, which is also 20% still. And that gives us, let's decrease the decimals on this thing. Hello. Oh, wrong one. Okay, 1.14. So the current financial, the beta under the current financial leverage, so let's call that current beta, is 1.14. Sweet. The optimal beta is 30%. Okay, let's see. If the optimal beta is 30%, no, optimal debt to equity ratio is 30%. What is the beta at the optimal capital structure? So let's do the same thing using the unlevered beta that we calculated up here. And let's say optimal DE ratio is 30%. Okay, so then let's take our unlevered beta, which is 0.98, and multiply it by 1 plus this ratio times 1 minus the tax rate. And that gives us 1.22. Does this make sense what I'm doing? So all I'm doing, once I've calculated the unlevered beta, I can manipulate the levered beta to be whatever I want under any debt to equity ratio. So this is just going to be 1.22. And sorry, I have OCD. Okay. And then the last question, if the 10-year T-bond yield is 4% and the expected market return of the S&P 500 is 9%, what's the cost of equity at the optimal capital structure? So we're going to use CAPM for this formula. So we know the risk-free rate is 4%, the market return is 9%, and the beta at the optimal capital structure is this 1.22. And then the CAPM formula is the risk-free rate plus beta times the market rate minus the risk-free rate. And it gives us a huge long number that I don't. Careful. Okay, sweet. So then the cost of equity is going to be 10.09%. Oh, hello. Okay. Okay, does that make sense to everyone there? What I've done? You will see that on the test. I'm almost 100% positive. So make sure you're comfortable with this. But it's not too hard once you get the unlevered beta and you have this formula and this formula, it's really easy. So, okay. Number 11. Do we have any questions so far though before I move on? Like, does anyone have any questions about anything we've done? I know we've got 4 minutes left of this meeting and then everyone's gonna have to hop back on. Sorry, that's annoying. I don't have Pro. So it might cut me off in the middle of this question, but I just want everyone to like ask questions for right now. If you're confused about anything. If not, we'll just move on. No questions? Okay, we'll move on. Okay, Ying Import has several bond issues outstanding. Okay, I know I'm gonna get cut off during this question, so everyone just hop right back on. I have to download the recorded meeting and hop right back on. And we'll keep going and I'll record the next one as well. But we only have like 4 questions left, so it shouldn't be too long. Anyways, okay. Ying Imports has several bond issues outstanding, each making semi-annual interest payments. Okay, before we even start, we need to make sure we understand their semi-annual interest payments. So that means twice a year, which means whatever rate we get, we're going to have to divide by 2, and the number of periods in years needs to be multiplied by 2 in our present value calculations. So, um, we're trying to find, so the bonds are listed in the following table. Sweet, we've got all this information. If the corporate tax rate is 25%, what's the after-tax cost of the company's debt? So really quick, I'm gonna make sure we understand tax rate is 25% and payments, interest payments are semi-annual. Okay. So we need to remember this because first of all, the interest payments being semi-annual mess with your present value calculations, and the after-tax cost of debt, that's probably going to be the number one reason why people get it wrong, is because they forget to multiply the final result by 1 minus the tax rate to get the after-tax cost of debt. So just make sure you remember that. So, and she's underlined it to help you remember. So let's look. So we need to find the market value, the weighted average of the 4 debt issues. So we want to first calculate the market value of each of these bonds. So we've got, so the price quote is 106.46 for bond 1, if you get where I'm talking about up here. So let's say market value of bond 1. Okay, we're gonna do 1.0646. I'm taking the price quote times the face value times the face value, which is 45 million, which gives me, oh, I didn't put an equal sign. I'm done. Okay. Which gives me 47,907,000. And I will formula text these so that you guys know what I'm doing. Okay. Market value of bond 2. So I'm just gonna do the same thing. 1.1502 times 40 million. Oh, again with the equal sign. That's embarrassing. 46. Let's copy this. Okay. 46,000. Oh, hold on. Oh, I forgot 1 decimal on this thing. Okay. Perfect. Market value of bond 3 is going to be 1.1357. Okay, so I'm taking the price quote times face value, which is 60 million. And then again with the equal sign. Okay. Formula text that as well. Okay, sweet. And then market value of bond 4